In this video, we're going to hopefully wrap up our discussion of how taxes influence the financing decision about debt. So this question is about the optimal capital structure. Do firms prefer debt? When they raise new capital, right, they primarily issue debt. They rarely issue stock. The aggregate equity issues, that is, the number of stock issues out there, is typically negative, which means currently companies seem to be issuing more debt and buying back more stock. So if we look at this graph, again, here's the total capital expenditures. So we're buying a lot more stuff. And as you can see, the net expenditures really is fairly flat. But what we can see is that equity is going down, and at least over the last 5, 6, 7 years, debt is going up. So it appears that we're buying more stuff and we seem to be financing it more with debt than equity. So it seems like companies prefer debt when they're raising capital, but not all investment is externally funded. Most investment growth is supported by internally generated funds, retained earnings, right? So even though firms haven't issued new equity, the market value of equity is still going up because they're using the internal equity, internally generated funds, to purchase most of their growth. So the average company, the result is the debt is a fraction of the firm value. And that goes anywhere from like 30 to 45%. So it's a very small amount. So if you kind of look at the debt to value ratio here, we have U.S. non-financial corporations. In general, you can see that over time, that we see the debt to value ratio has declined in total. And in addition, especially over the last 5, 6, 7 years, the S&P 500 indeed shows a decrease in the debt to value ratio. So it seems like companies want more debt, but it seems like companies aren't issuing more debt. So the use of debt varies greatly, right? Some industries are more debt intense than others, and even within industries, some companies choose this. This is why I kind of look at this idea of financing as really a lot more personal choice than some type of a technique to figure out how much you want to do, right? Some management teams are very conservative and they'll try not to borrow very much. Others are just the opposite. So to get the full benefits of the leverage, does a company need to have 100% debt financing? And again, this concept of getting this whole bet just basically says, look, you don't need to have 100% debt financing, but you absolutely positively have to have taxable earnings. So this constraint, right? You can't have more interest than you have EBIT. So again, you don't have to 100% financing, but you have to have taxable earnings. So here we go. So we have a company with no leverage. So the net income $650. If they have high leverage, $1,000, they're down to zero net income. The tax saving is $350. If they have excess leverage, more than what they need, now what we find out is that now, just with excess leverage, there's no increase in the tax benefit. So once you go to negative income, you no longer have this tax benefit. So just to kind of revise through there, right? With no leverage, you don't get any tax benefit. With moderate leverage, you're going to get some tax benefit. If you choose too much, you're now not going to see any increase beyond that maximum amount. So again, how do we figure out what that maximum amount is? So no corporate tax benefit arises from incurring interest payments if, again, they exceed the income limit, right? In this case, EBIT is the absolute limit, right? If that number, if EBIT minus interest is negative, you don't no longer get more of a tax benefit. You get the tax benefit, but you don't exceed what it is at that maximum amount. So the optimal leverage, a level of leverage from tax saving perspective, right, is just EBIT. It's very difficult to predict this though. But in general, right, a company wants to try to maximize as much debt as they feel comfortable with, and then achieving the maximum amount of tax benefit based on their strategy. However, again, with this caveat that you cannot exceed EBIT. So as its interest expense approaches taxable earnings, this tax advantage declines. I think that hopefully makes a little bit of sense moving forward. So let's look at this next figure and see what it tells us about some patterns that we might see. Right. So here is interest divided by EBIT. Right. So here is the general relationship between interest and EBIT, and here are the percentage of firms with negative pre-tax income. So what you can see is that I don't want to say it's very stable. It's pretty much somewhere between 5 to 20% on average, but you can see that there is a relationship between the amount of debt companies have and the amount of interest they have. As interest increases, we also see an increase in this ratio of interest to EBIT. So it appear that firms on average are under leveraged, right? They don't seem to have as much leverage as what we've been talking about here. So in reality, what the issue is there's far more to this story than we're just discussing. We have not taken into account the probability of bankruptcy. Bankruptcy is very expensive. So we need to incorporate that chance into our financial decision making so we understand now the influence, not just of taxes, but now of the potential financial distress when debt gets too high. Look forward to seeing you in the next video.